Thank you, Jane. That was a great video, it really was. And Harry, always inspirational, although I have to say I didn't come here to listen to you talking about bullying and alcohol abuse. Got quite enough of that at home, frankly. But I mustn't waste any time. So you've already seen from the slide who we've got coming on. So please give a very warm welcome. They're going to speak on this very far-reaching topic until 10 o'clock precisely. So please welcome Michael, Mark, and Peter.
Good morning, everybody, and delighted to be here. For those that don't know me, my name's Mark Edwards, and I have the privilege of heading up the Leisure and Hospitality team at BDO. Great to see so many people in the room, and staged slightly off-centre, meaning it harder to make sure we capture the people over here, which is the biggest risk for Peter, of course. So presumably the people over here, if you're feeling left out, you can just yell up to him, "Peter, pan." Anyway, maybe we'll leave the jokes to him. Okay, we are going to canter through a couple of bits on my side, and then a hand over to the data experts with Mike and Peter. And then we'd really like to open up some debate. So if you have questions that you'd like to ask us, particularly if you're challenging us on some views, that would be fantastic. So for those of you that heard me speak before, this is a model that we used coming out of the pandemic to try and talk people through what we thought was going to happen in that post-pandemic era. And I guess the only thing I want to really capture in this is that resilience stage we thought wasn't going to go on that long, and we were hoping that we'd be in realize and adding value, etc., etc. And clearly, we've had more challenges than could possibly be imagined. And that seems to continue budget-wise, etc. What does that really mean? Well, my first prediction going forward is I think we're going to see some change in strategies and possibly some change in leadership across a number of entities. We tend to see that in the hospitality space. Lots of people who have worked incredibly hard throughout the pandemic, coming out stronger, using lots of words like resilience, being adaptable, ready for change. But now we've got another set of challenges, and that tends to lead to some fatigue with where people are. So I think we could see some change in leadership across the sector, which could be quite interesting to watch. Now, I did say last year, please, please, please don't leave the room talking about cost of living crisis, because it begins to embed in our psyche, and I'll use similar language today. This is a consumer confidence index over the last year, and you can see that really people should be feeling positive. But one can't help thinking that if you read the media, it doesn't always come across like that. The ASDA income tracker, which CEBR produce, you'll see again, it looks more positive than you might imagine from the press. And again, another theme. While I totally understand that the budget has not helped our sector in any way, and I also understand why it's so important to campaign on these matters, it's also critical that we don't allow the story of challenging times in terms of employment, in terms of opening hours, etc., to begin to impact a consumer's psyche. Because if what they are hearing is that actually businesses are really struggling, then it's harder for them to commit spend. If, from an employee's point of view, they hear that jobs and hours might be at risk, it's harder for someone to commit to a career in the sector. So just a kind of friendly warning that we need to be careful with our messaging and just to be as positive as we can about the opportunities within our great sector. Just looking at a bit of travel data. So travel market, particularly in the UK, rebounding to pre-pandemic demand levels, year-on-year growth in 2024. Demand driven by affluent travellers, Gen Z, and the grey pound. So I'll try not to be too negative about the budget, but we might hear that from others later. Clearly, some of those categories might be quite impacted negatively by the budget. So there is a slight risk that sits there. And again, I will just say this once to get it out of the way. There is a nervousness that I have with this budget, and I'm looking forward to Thomas coming up from the economist view later. And that is that there's obviously a desire and a requirement to raise a lot of money through tax. because of this NI, or through this NI increase. But if that isn't achieved, there is a risk that there will need to be further increases in taxes later. And the reality is that's going to hit those affluent travellers. So there is a downside risk, I think, sitting there over the next 3 to 5 years. So what are we seeing? Volumes are up, and that's good. And even business travel, and we'll come on to that business theme in just a minute. Financial results are better, but significant operational challenges. The ATOL system changes, which many will be aware of, good for consumers, but increasing costs, particularly for smaller businesses. And that segmental piece, again, we'll come on to some more data with that shortly. So a couple of survey bits from our own data, and this is where you need to be careful with consumer sentiment surveys. Consumer sentiment, so this is about, are you going to spend more money? Summer 24, which is the latest one we have, the current survey is out there, pretty flat. So while we've got that graph showing that people have more disposable income, the actual desire to spend it is not as highly confident. And then if we look at where people are prepared to spend their money, based on our survey data, travel, good, that's nice and high, highest, most positive, but it's probably the most sensitive. So people tend to back their pets over their own travel, and healthcare is obviously a kind of staple. Right, this is another statistician's delight. So if you look on the right-hand side, first of all, it's all green, which of course means fantastically positive. If you actually look in the middle column, what that's saying is it's less bad than it was previously. So cautionary tale. And we just need to be very mindful of that. So it's good that people are not planning to cut back as much, but it still means you have to fight extremely hard for every pound you're going to earn. This is a bit just around that demographic piece again. So looking at, in some ways, the most interesting income one is the one on the right-hand side. That middle bar is quite concerning because depending on where you structure your business, that could be quite detrimental. The Gen Z is probably the most sensitive to changes in job prospects, so just something to be aware of. Okay, and this is a discretionary dial, which basically says if you were able to take some time off a long weekend, would you be able to do that financially, and how much would you be prepared to spend? So the actual number of people prepared to do that has been pretty stable over this review period. The amount they're prepared to spend just falling slightly. Again, cautionary tale. Okay, this is the slide that I present every time, so it will be no surprise to anyone in the room. But great product, number one thing to sell. So my warning here, people tend to have short memories, which is a shame. I'm an accountant, worse than that, I'm an auditor, so my memory is indeterminably long and very risk-focused. And so what I remember from the last time people started having struggles struggles sounds very negative. What I mean is when there was a negative sentiment or less positive sentiment, was that CapEx would be one of the first things that was held back. And I do think that is a risk at the moment. We know that interest rates are likely to fall less quickly than originally anticipated. That means debt cost is higher than it would have been. That means CapEx plans may be pushed back. In certain markets, there is also a lot of supply coming onto the market at a very high level. And that does mean, I think, for an existing business, there is a challenge if CapEx investment plans aren't maintained. Next point, great service. So that's about people in lots of cases, but then people are going to become more expensive. One cautionary tale in the hospitality sector that I tend to see, people say, we don't pay minimum wage, therefore increases in minimum wage we can manage more readily because we pay above that. Clearly there's the ratchet effect. But just be very conscious, of course, that the headline gives the percentage increase that those on minimum wage will feel. If you're paying at a rate above that, even if you gave the same absolute increase, this is on a timer, I'm obviously going slow. If you give the same absolute increase, that is a lower percentage. Of course, if you try and narrow that gap between the minimum wage and what you're actually paying people, the percentage that you're offering is even lower. So there is a risk that we have turnaround of staff, which we had obviously post-pandemic, as people tend to be quite sensitive to the small pay scale changes, and so quite a lot of movement, which then impacts service. Great location. Biggest challenge there, of course, is what used to be a great location might not be anymore, and that's a real challenge for all of us. Not a lot you can do, maybe. Value for money, that's always going to be crucially important, ensuring value for money. It is going to be so much cheaper, believe it or not, to make the most out of everyone that is in your building, your hospitality venue, hotel, than to acquire a new customer. And ideally, you want that repeat custom by showing them great value for money. That's it from me. I shall hand over to Michael. Thank you very much.
Thank you, Mark. I think there's some pretty good info there. Believe it or not, this is the first time I've actually stood on this stage. And as someone who spends most of my time at investment conferences, I think it's quite nice to actually be in a room full of hoteliers. So looking forward to a really good day today. I'm going to run through the slides because I'm in a room full of hoteliers. Hopefully, I don't need to explain who we are and what we do. We collect P&L data from hotels globally, and we offer benchmarking services and market data for the investment community, banks, etc. But I won't go through a sales pitch. I'll go straight into where we are globally. So on a macro level, this is always interesting to start on a macro level, the hotel industry generally has been a pretty good place this year. But we've definitely seen a slowdown on the top line, and therefore, in many markets, a slowdown on the bottom line. Now, what you'll see generally as a pattern across the board is that the Middle East generally has been outperforming the rest of the world. You see Asia Pacific's been quite bumpy, and that's mostly because of the return, non-return, then return, non-return of Chinese travel. And then from a European perspective, we've just not only seen revenue continue to grow, but actually profit grow quicker than revenue. And I'll come to some of that in a moment. A bit like Manchester United, the UK is sat mid-table at this point in time on a European perspective. And you'll see that actually, again, the pattern that I was talking about then across Europe, it's not just affecting individual countries, but the pattern is very much that you'll see that profits have grown substantially more than revenues over the last 12-month period. And again, I will come to that a bit further in a moment. But generally, as I said earlier, we've been going through the last couple of years pretty good revenue growth. And of course, that's coming on the back of a fairly low base, but powered by rate. And of course, the demand levels that continue to layer on top of each other. Demand of hotels has changed, but we've been driven by price. And again, that has been different to previous crises as we've come out the other side of them. Generally, it was driven by occupancy, and it takes a few years to get the rate back. But we've actually not only been able to grow rate, but maintain it. And I think that's been some of the success story and some of the indicators for going forward. But you'll see the lines have started to flatten. So we are going back to that pre-pandemic style of growth. So we'd be looking at that 3 to 4% growth that we generally would have considered to be strong pre-pandemic. And again, the big challenge is all around what happens to the cost lines, because as Mark just mentioned, certainly in the UK, as we see not just living wage increases, but changes to policy on the likes of national insurance, we need to be able to drive revenue to offset that. But generally, as you can see across the UK, and I think some of those might be a little bit small for those of you at the back, but what this graphic is showing is those on the right-hand side of the chart have seen revenue growth over the last 12 months. So that's the markets that have seen top-line TRevPAR growth. And then those on the top half have actually seen margin increases. So the only market you can see here that over the last 12 months has seen margin growth but revenue decline is Manchester. And those on the bottom left here of those who've seen a decline in revenue and profitability. So as you can see, most of the UK markets are up in that top section of revenue and profit growth over the last 12 months. And where's it coming from? Well, from an occupancy perspective, it's been fairly muted, but we've seen growth in the transient segment, so corporate and leisure customers on an individual basis. And we've seen a decline on the business groups, which is kind of out of sync with where we thought we were going, because the return of groups has been part of the success over the last 18 months. But certainly more recently, we've seen a bit of a tail off from some of those large groups staying in hotels. And actually the uptick has come from the share of transient corporate and actually that mixed segment of retail where you basically don't know which of those segments they fit into. From a rate perspective, we've continued to see growth. So it's a bit of a mixed bag across the segments, but generally seeing the group business at a higher price than what we were selling pre-pandemic. And as you can see, the transient segments have been very strong. Corporate customers are paying a lot more than they were pre-pandemic and versus last year. From a revenue perspective, I think this is another area as we start to see ADR possibly starting to flatline. We certainly can't continue to charge at the levels and the speed of the growth that we've seen from an ADR perspective, but it's good to see the ancillary revenues also growing, so that price per customer or the revenue per room sold continues to grow. And even food and beverage, which again was been the last 2 years, I spent most of the time talking about declines in food and beverage revenues. It's again a mixed bag across the markets, but you'll see on the right-hand side there, some of those markets have seen significant growth over the last year or so. And this is comparing the summer months. So this was actually, looking at that last 3 months of, the last 3 months of our data, showing that that was actually a really strong summer of spend in food and beverage in particular. Now, where is that coming from? Well, you can see across the board, actually, the growth by segment has been fairly muted. So we've got a 3.4% increase there in restaurant revenues. Bar food, you can see there it's 6.3%. But, generally, those numbers are a lot smaller than what we would have needed to offset what would have been quite significant cost increases. But we do have a tailwind. And the tailwind for us has been the return of conference and events. And that, again, not just from a revenue perspective and for giving a bit of reassurance for those conference hotels that I think there was a lot of question around whether we would be sat in a room like this again. This, again, is a real positive sign. And it also, of course, influences quite heavily the profitability picture. And you can see, again, it's across the UK. So if I compare it to 22 or against 23, you can see we have continued to see further growth, more in some than others. But yeah, if only I had someone with a little bit more meeting and events data and expertise next to me. And on that note, I will hand over to Peter.
Right, hello everybody. I'm the new kid here. Nobody knows me. Nobody knows who I am, what I do. And my data set that I've got today is a new one to the HOSPA family. So before I start, I'll just give a little bit of background as to who the heck Venue Performance is and what we do, so you got an idea of where the data's coming from. An interesting point, actually, Venue Performance came from because we started our life in the venues market, because the venues, i.e. non-bed properties, were notoriously bad at measuring their measuring everything, quite frankly, externally anyway. So we created a benchmarking platform for the venues market, and then the hotels said they wanted it as well, and we thought that they were already doing that, but they said they were, but they were doing it for beds, not necessarily for M&E. So we created the unified data model for meetings and events, which a lot of people said couldn't be done. We've done it, and we think it's fairly logical and simple and straightforward, and I'll demonstrate some of the data. I won't go too detailed with the data because we're all going to get dated out if we're not careful. So I'm going to do top line stuff, and obviously anybody that has any questions, they can come and find me afterwards. So the best way to think about us, and this is a massive apology, I know, you all know STR, right? I mean, obviously we all know HotStats, but we all know STR, and we do what for M&E what STR does for beds. We don't do P&L, which is why we're not similar to you, Mike. We don't do P&L, we just do sort of commercial data. And just to give you a quick one, this data is taken from about 400 properties across the UK. We're working with all the major brands and the operators, so the data set is pretty healthy. And that's just an idea of who we work for. Because we've got this new data set, we've been pulled into DMOs and associations. We're even advising on the government in the APPG, so we help them with Kate and the hospitality group, tracking this relatively new sort of focus. So, okay. Right, I'll let you focus on this for a bit because, like I said, this is all brand new stuff for you. So what you're seeing here is the average number of events per venue per month. The dark line is the average number of events per venue per month. The dashed line is the average number of sales per venue per month for any point in the future. So what the dashed line does is it shows you the intent. So the pace of booking, the pace of confidence in the industry of what they want to put their cash to. And the darker line is showing you, obviously, what that looks like in terms of actualization. And we're looking at all event types, so whether it be a conference, a banquet, a reception, a meeting, we're looking at all event types of all sizes across the whole of the UK, and we're looking at January 23 to the end of December 2024. Because of the way that the data is collected, we can see into the future, which is a pretty cool thing. And the reason why the dashed one falls off a cliff is because we haven't yet got October data. So now to put this into a bit of context, because that looks a little bit flat-ish, but if we put it into a bit of context and go back a year to 2022, I think, yeah, 2022, what we're seeing is a general positive upward trajectory for meetings and events. So the theme is, as Michael's data suggested, and probably why I'm standing here, is give it a little bit more meat on the conference and banqueting bone, as it were, is the general trend for meetings and events is up, which is great news, and it shows in the figures as well. Now, what that means in terms of some KPIs, revenue per delegate is going up, which is good. Lead time, which was a scourge of the meetings and events industry, all this last-minute nonsense, which was causing chaos within properties in terms of teams, especially coming back post-COVID. All of a sudden, there was that pent-up demand that everybody's talking about, and it was putting real strains on the organizations. So the lead times that we're all used to working to, and that rhythm of, you know, sort of spring and autumn for the big conferences was all shot to pieces. So that was a real stressor on the organizations. And that lead time is lengthening out, which again is a sign of confidence within the planners and the bookers. There was a little bit of dip in delegate size last year, which was a bit of a concern because we thought, is that a trend? Events are getting smaller. So there's more of them, but are they getting smaller? And obviously from a revenue point of view, that's a bit of a kicker because if you shave 10% off your revenues every time you run an event, that soon adds up cumulatively. But the good news is they're coming back. And then what we then thought we'd do is we'd then sort of focus on some two key areas, which is the larger events, conferences, banqueting, award ceremonies, that type of thing. And again, you can see the general trend is up. However, look at May 2024. What we all know happens sometimes, and I'm not going to get too negative, Mark, I promise you, is that these big events have an impact. And we had the general election, which stalled everything for big events. It's a different story in a minute, but we had the big event stalled for the general election, and obviously then we had the budget. We had the first part of the year with obviously all the financial nonsense going on. So there's been a little bit of a tail off, but if you look at the darker line, it's still going on. So there's a lag probably in the bookings, which is the dashed line, versus the actualization of events, which is the solid line. So that's just something to be aware of. And we're looking at big events from 100 to 500. So they're the really big chunky ones, the ones where the businesses really have to write big checks and be confident about their finances going forward. Now, if we look at those conferences, however, in terms of the KPIs of the big events, they're all looking pretty strong as well. So that's good news. Meetings, smaller meetings or smaller events, so we've looked at the big events, we're now going to look at the relatively small events, that trend is still pretty strong. So there's a question of whether they're putting off the big events and running more of the smaller events. That's certainly a trend that we're seeing. But the guts of the meetings and events industry that you all run day to day is predominantly meetings and conferences anyway. So the good news is that the meeting sector is still very, very strong. KPIs for meetings, they're all pretty good as well. Delegation size is pretty flat, but lead times and revenues are going up as well. So again, there's a general message out there that the meetings and events industry is pretty buoyant. And if you've got a meetings and events property or you've got meetings and events business that you can tap into, then this is a real sort of tailwind that's going to really focus on. And that's obviously why we're standing here today and we'll have a conversation about that. So in summary, for meetings and events, it's looking very, very positive. The large events have been affected by the various national events like the budget and the general election. But in general, when you look at the whole, the trajectory is still pretty positive. And of course, the lag of the larger events is probably going to be into 2025 when there's that confidence of stability, which is as much as anything is really going to sort of come back. So I think we still expect those to come back pretty strong. Meetings are growing and the market is stabilizing, which is what we want for big ticket spending from those large organizations. So that's it. That's my little bit, and I'll pass back over to Michael.
Thank you, Peter, and thank you for going slightly over your allocated time. So I'm going to be pretty quick on this. So yeah, the impact on the profitability picture in general, again, kind of coincides with what Peter was talking about there, about charging more in the way of M&E. That's actually translated in food and beverage profits, which if you saw over the last few years, we have continually seen declines in food and beverage profits really at a macro level. But it's nice to see this year on year we've seen gains. And most of that has been driven by the return of conference and events. But from a profitability perspective for hotels, you'll see, from where we were in 2019 and how it's kind of materialized over the last few years, you see it's pretty, we've still got some way to go if we were ever going to return back to those levels. And that is at the same time of us offsetting the continual cost creep. But how have we managed to gain margin year on year at a time where revenues have been fairly strong, but nowhere near the level that we've seen a lot across many of the cost lines? Now, this was double meaning, of course. Labour have actually, to this date, can't take the blame for what we've seen from a cost perspective, but the actual payroll lines are certainly not the areas that we've seen the gains from a profitability perspective. Overall, we've seen 4.5% increase in total labour, and that includes, of course, a lot of efficiencies that hoteliers would have put into place over the last 12 months. The big areas, quite surprisingly for me, were in the areas of the back of house, so sales and marketing, property and maintenance costs from a labour perspective growing quickly, and of course housekeeping exposed to the living wage increases. But actually, it's the cost lines, so the expense lines themselves that we've seen the savings. So, a bit of saving in the food cost, beverage cost areas as costs are starting to stabilize. We've, of course, put all of our prices up of what we're charging customers. And again, the return of conference and events will have a huge impact on this. And of course, the big one, which is the utility costs. So as energy costs start to come down, a lot of predictions from events I was at this in the last week or so is that the energy costs will continue to fall. Of course, we're going into that peak time of the year now from a consumption point of view. So of course, energy costs are at their highest. Just a couple of footnotes there as well is the insurance costs. So I think for many of you who are operating hotels here will be aware of this already, but the UK has seen some of the highest increases in insurance costs globally. Nowhere near the US, but of course you can see here that has certainly been a challenge below the line. But overall, across the segments, hotels are generally at a macro level making more money than they were, other than the ultra-luxury segment, where we've seen quite a lot of supply enter the market, and again, on the back of a few very successful record-breaking years. And then from a segment point of view, if you look across, it's really the resort properties, the experiential properties that have seen the largest growth from a margin perspective. So in the golf wellness resorts, and that links back to what I showed you earlier from the increase in wellness revenues. Overall, again, just a couple of notes before we jump into the discussion. I won't read through them all, but generally we're charging more. We'll continue to find ways of increasing the spend per room sold. We'll get into the discussion, I think, on F&B, because I think there is quite a bit to talk about there. And then energy costs certainly propping us up from a margin perspective, and hopefully will be a tailwind going into this year also. And on that note, I guess we'll jump into the discussion.
Thank you. Forgive me, I'm going to come up here only because
join us here.
I know, but it's easier for me to see in case we have burning questions from this side. But I am going to pick up on the F&B thing first of all, Michael, because I have stood here and other HOSPA places and suggested that this industry should start talking about R&B, restaurant and bars, rather than F&B. But obviously, what we're seeing in the hospitality industry generally is some challenges, particularly casual dining and restaurants generally. What does that mean for hotels? Is that an opportunity or a risk there as well?
So from a profitability perspective, those high street restaurants and bars are of course left exposed when we see increase in pricing of supplies, labor costs and energy costs all at the same time, right? Oh, and insurance costs, rent, etc., right? So they don't have the ability to offset some of those challenges by highly profitable bedrooms. So certainly hotels are in an advantage in that way of thinking, because generally food and beverage can run at a small margin and the hotel will still make profit. So it, you know, in the big picture, it can be absorbed. I do think that, and this has been quite a big discussion during the investment conferences, on the back of Whitbread announcing recently that they're going to close some of the, or quite a lot of the beefeater restaurants, or bring them inside of the hotel where it makes sense, but actually convert those restaurants into hotel bedrooms, is a sign of the times, right? It's a sign of the biggest food and beverage operator and hotel operator in the UK making such big decisions. I think is a sign of the times, is that actually standalone restaurants are struggling, and actually having them within a hotel or using them for bedrooms is actually more profitable. But actually, if you think about all of the trends, and they do feel quite negative, there has been a downturn from retail, and seeing some of these high street restaurants and bars closing could mean a reverse of what we've seen of the trend over the last few years, and actually an advantage for hotels. Maybe we'll see some of that coming back, and hotels becoming more of that destination for food and beverage again.
Thank you very much. One of the topics that we get asked about quite a lot is return to the office. And what will the impact on that mean? And I'll just give my personal comment, and I should stress this is my personal view before either members of my firm who are in the audience take umbrage, or indeed anyone else quotes me. But my personal view is if we have any challenges in the economy generally, we will see a higher rate of return to the office. That tends to be the case, so presenteeism. Albeit I understand that some people are arguing that what the flexibility of agile working might be an offering to offset lower pay rises. But I can't help thinking that if we get to whatever normal looks like, that must have an impact on meetings and events. So, Peter, what's your take on what that might mean?
Gosh, you're asking me to be a futurologist,
Yes.
which is a tricky one. I think there's an opportunity for hotels. I mean, personally, for example, I'm one of those digital nomads, so I don't have an office, and I travel a lot. I always go to hotels to do my work. I never go to cafes and that sort of places because they're too noisy there, and hotels are all geared up for it. I think there's some tech coming down the track with the old instant book thing that you can book a bed online, you can book a plane online, you can't book a meeting room online. I think that will help a lot, because you can utilize spaces a lot more for meetings if it's easier and if it's simple, and if they know they've got the services there. They don't necessarily want the full-blown service. They want a meeting room at a price, because they can go in, have a meeting room and leave again. But if they know they've got the services at their disposal, I think there's a huge opportunity for hotels to tap into that market personally. But again, it's all to do with the type of hotel, the area they're in. But yeah, I think that's a big one to tap into.
Okay, so I'll ask one more before we open up to the room, which is investment in tech. Sounds good. Sounds like a way of avoiding spend on labour if we can, so we can make savings there. But that might not always be the answer. So, Michael, what do you think on what's the right option? Are we going to try and take labour out, or stick with it?
So from a tech spend point of view, I think there's a few things to consider, right? The tech landscape over the last kind of 10, 15 years has changed massively. So it's when we say tech, I think we're thinking about, just IT systems, AI, but, there's been massive enhancements in how we deal with the MEP in hotels, so the actual, building management systems. We've got most of these services have moved to the cloud. So it's more of a ongoing subscription basis rather than a huge capex item. So number one, I think that's enabled hoteliers to be a bit more nimble and be able to embrace some of this technology the way we couldn't before, because huge capex spend normally a relationship with an investor or an owner to kind of do that has changed, because now a lot of this becomes a subscription service and in the hands of the operator. But the flip side to that is that cost ends up in the P&L, right? So we have seen a significant chunk of that growth, and also in areas like marketing, which we've changed the way we traditionally sell to people. So therefore, we've seen increased spend there. When it comes to actually, replacing labor, I mean, I guess I'm a bit of a contrarian on this discussion, because I genuinely think that when you have people, like when people are on shit, as long as you have that kind of ROI mentality, as long as you're able to actually make sure that the upselling, the commercial nature of everybody that's working on property is maximized, you should be able to get a return on investment on having staff there. And actually removing staff, it removes that enabler for you to be able to upsell, right? So I actually believe in that. But I do think technology supporting that, giving them the information for personalization, finding the opportunities, supporting the staff to be able to do their job, which has become more and more challenging, to say the least, as we've squeezed the labor on property in hotels. That's where I see the opportunity really for tech. Not necessarily to replace people, but to enable them to sell more, to drive top-line revenues. Because I don't actually think we're going to be able to hedge costs in a way that we probably need to over the next few years as revenue start to slow down. It's going to be finding new revenue streams that is going to be the answer.
I think you can replace people. And we're not talking about getting rid of swathes of staff. I think, look at the small meetings chart. That was going up. And if that trend continues, and the remote working continues, and hotels have managed to create a facility where people think about going to a hotel for a meeting room, then if we make that process a lot simpler and easier and seamless through the use of tech, which is there, and you have your staff around them to upgrade or upsell or what have you, or even the tech to say, actually, we want to stay for a bit longer. Let's just book an extra 2 hours, or actually, let's have lunch. Let's order some sandwiches, or some fruit, whatever it may be. I think that you're then freeing up your staff for the bigger stuff, which is the bigger events. And you've got data. You've got I think the tech in small meetings specifically, booking, servicing, fulfilling, upselling.
100%.
I think the tech in there is a wide open goal to shoot at.
Thank you. Do we have any questions from?
Put a hand up if you'd like to ask a question. Doesn't matter where you're sitting. We'll run to you.
Right in front of us.
At the front. Oh, okay. A very brief question with a brief answer, if possible, because you've used your time so productively, gentlemen.
We've got 5 minutes left.
My question is, do you see a trend where hoteliers, particularly in London, are going for lower occupancy and higher room rate, which obviously saves on labor?
So there's definitely been a shift in segments, as I kind of alluded to earlier. So as at the point where we were able to drive such high rates because of this pent-up demand, because of the money in people's pockets post-pandemic, there was definitely a lag in the return of groups. And when groups were staying at hotels, those lower-ended segments, they were being charged a lot more. And of course, on the back of that, some hotels, I think, had already decided that their segmentation, and it doesn't work for all hotels, it's really hard to have a kind of macro view on this. But for many hoteliers, I think there was a good decision on a lot of that bread and butter business, that kind of cheaper business, actually was at a cost to them, especially as costs had started to go through the roof. But I think there is, in general, the mentality has been, we literally have to drive rate because we are seeing these cost headwinds, as we've seen over the last years, in significant levels. We're talking, well above inflation, increases in energy costs, labor costs, etc. So it has driven hoteliers to make that decision in a different way. As the model kind of expands and we go further forward, that growth in occupancy, those next layers of occupancy. Remembering the UK is a leader in when it comes to general occupancy levels. We sit at, I think, number one at this moment certainly in the developed countries. So how much more room is there to drive occupancy in hotels. Rate has definitely been the option, and I don't think we can just look at rate and occupancy. The thing I'm passionate about, certainly from a HotStats perspective, is that we look at new revenue streams all of the time, and we don't just try to compare golf, wellness, F&B, M&E. There's, of course, new revenue streams creeping up all of the time, and that creativity is really what I think is going to be the next level of this. I do a lot of work with many of the hotel chains, and this analysis is exactly the exercise that they're all going through. Should we continue to try and push rate at the expense of occupancy, or as the labour supply challenges become less of a burden on us, maybe there's no longer the need to do that, right? We were capping occupancy in some, coming out the end of the pandemic, capping occupancy in restaurants, in meetings, in bedrooms for that purpose, right? But I think that has shifted now, and we're starting to go back to the kind of previous, the existing models of trying to drive both.
Yeah, I'm just going to add some anecdotal bit, but I think one of the challenges that's going on at the moment, my guess is the budget cycle is going to go on for longer as people try and work out what the budget is going to look like. And obviously in the last year, you have a US election, which tends to slow down travel from the US, so people hope that US travellers will return. The Middle East has been challenging, so that market's harder. So it might depend a little bit on where you get your customers, when you're going to drive your rate. But definitely it's true. If you walk around this room today with any operator, they will say, we don't want to drop rate because it takes so long to get it back again. But the nervousness exists as soon as you leave the room, and the temptation is to drop rate and to go back to groups and so on. So I'm going to suggest that rate will begin to fall because nervousness exists in our psyche. And so, yeah, next year will be a bit lower.
I would also add as well, just mathematically, as the segments shift, there is automatically a change in average rate, right? Because it might not be we're charging customers more, it just might be that we have more of the higher paying customers in the hotel. So it might not be that we're actually charging customers online a significant amount more. I can tell you we are, because even the economy segment, we're paying in London now well in excess of £100. But you can see the gap is actually, a lot of that growth has come from the fact that the higher rated segments have actually taken a larger share of the segmentation pie as well.
Perfect. Thank you very much. We are now going to be out of time, so my apologies for not getting the questions through, but it does mean these guys I know are desperate to answer questions. They love challenging questions, so please come up with as many as possible. I'll do the same, and enjoy the rest of your day. Thank you very much for your time.
Thank you to Mark Edwards, Michael Grove, and Peter Heath. And thank you for finishing on time. And I'm sorry we didn't have more opportunity for questions, but I didn't see hundreds of hands up, so we were lucky there.